that, let's jump right in on inflation, deflation, and some of the things that Danille was talking about. Where do you think we're headed?
Well, people ask all the time, are we going to have inflation or are we going to have deflation? And I say, yes, I think we're going to have both. And I think we can have them both at the same time. And people have a hard time getting their mind around that because they only know how to think of numbers in terms of the dollar. And yet, if you look at things like real interest rates versus nominal rates, or you look at real wages versus nominal wages, and, not to get wonky or anything, but basically nominal is just a number. So it's a number. You and I are old enough to remember where if you made $50,000 or $100,000 a year, you were upper middle class. That was a good income. Well, it's not that way anymore. I read an article the other day that lower middle class, just to scrape by in San Francisco, is $300,000 a year. Well, it's not that the lifestyle got so much better or the work became so much more valuable. It's that the dollar that you're paying for it all went down. So in terms of your lifestyle, in terms of your purchasing power, you deflated. You lost the ability to purchase. And yet in terms of the nominal, the amount of dollars actually coming in, flowing through your hands, the numbers went up. And you see that with your tenants. Tenants might be paying more rent and earning more wages, but they're getting smaller places and they're having to pay more for their cost of living. They're struggling. I mean, it's really, you probably know a lot more about it than me, just managing your portfolio of tenants. But, gas and food and healthcare, everything has gone up. College tuition, when you get to that stage in life, raising children, I mean, just everything costs more. And even though your wages are up, your cost of living is up more.
So can you break it down for me so we understand what inflation and deflation is, but what is stagflation? Because that's where I start to get confused.
Yeah, that's perfect. So stagflation is where you have nominal growth, where the numbers get bigger, but the actual productivity goes down. And the way I explain it is if you had, say, an economy that was producing, or a business that was producing 1 million widgets at $100 a widget, then you'd have a $100 million company. And let's say you needed 10,000 employees to do that. And that means each employee creates 100 widgets, a year, or whatever the number is, whatever their productivity is. But now because of inflation, you actually have to sell those widgets at $108 or $120. I'm sorry, $120. So now you'd say, well, if I sold $1 million widgets at a $120 million company, but I lose some market share when I raise the price. Some people can't afford the 120. So now I'm only selling 900. Well, if you do the math, and this is coming right out of the presentation I did on the summit, if you do the math, the 900 times 120 is 108 million. So in other words, your company has grown nominally by 8% because of 20% inflation. Your price went up from $100 a widget to 120. You sold 10% less widgets. But when you do the math, your sales in terms of numbers, nominal dollars, went up 8%. So you look like you grew. But based on the same level of productivity, you need 10% less people. So you lay off 100 or 1,000 people. Now you only need 9,000 employees instead of 10,000. And instead of selling 1 million widgets, you're only selling 900,000 widgets. So what the world got in the real world, what the real world got was less jobs and less products, and yet it looks like the business grew. That's stagflation. When the numbers go up, but the supply goes down and the economic activity goes down, and that's how inflation distorts what's going on. It's very hard as an investor, it's very hard as a business person to know what to do in that kind of an environment.
What are you guys seeing? And where's all this madness going? Because these markets and these real estate classes, they're all very different and independent of each other. But what do you see? What are some of the bigger trends you're seeing right now with your data? Because you guys are rolling out this quarter right now, right?
Yeah, we just rolled out actually the most recent quarter data, and our forecasts have just been updated. And realistically, really is, we're seeing so many different storylines depending on the specific asset type. In terms of, obviously, just the big headline industrial was kind of the darling throughout the pandemic. We saw record levels of absorption, leasing, construction. Amazon alone here in Dallas-Fort Worth is the largest industrial user of space in the Metroplex, with over 18 million square feet. Just to put that into perspective, like big companies like FedEx has like 4.5 million. So they've definitely dominated the market. But the latest headlines I've seen in a few publications today is they're starting to, they might have overextended themselves a little bit. But in terms of where the market is in terms of industrial, I think we're going to see, as long as demographics is destiny, kind of like the multifamily market as well. When you take these high growth Sunbelt, non-gateway markets, and just the number of people moving, Dallas-Fort Worth is adding 120,000 people a year. In terms of the office, I think there's a lot more question marks with the office market than we anticipated. Obviously, the hybrid return to work, just has really caused a lot of uncertainty. One area I'm looking at really closely is the amount of sublease space on the market. We continue to see just a groundswell of sublease space just really affecting rent growth. Very few metropolitan areas are experiencing any true rent growth in the office space. Multifamily, I think, there's been a lot of, it's definitely, we're seeing the strong markets, I think, are getting stronger. Those Dallases, the Nashville, Charlotte, Phoenix, they are in a strong position. And the retail, you know what? Everyone thought retail was dead.
Yeah.
I call retail the Lazarus of asset classes. Every time you write it off, it just seems to reinvent itself. We had a lot of, obviously, e-commerce, total retail sales. E-commerce accounted for 18% during the peak of the pandemic. Now that has kind of gone back down to a normal about 14%, kind of where we were heading into pre-pandemic levels.
So for those people, we get this question all the time, right? I'm waiting for the crash. I'm waiting to buy for the crash or for the adjustment. What do you tell them?
I got a client who's been waiting for the crash now for 9 years. It's really interesting. It's like we don't have a crystal ball. Nobody does. It's whether you're buying crypto, whether you're buying art, whether you're buying real estate. Nobody has the crystal ball, right? We all look at the same fundamentals. We're all listening to the same analysts, experts, professionals. I often say to people, suddenly when they're looking for their family home, so I'm not referring to investment, I'm looking to family home, which is also an investment. You have to look at the next 20, 30 years. And then if I go back to 2008, when we had the economic subprime crisis, most people that lost their homes back in 2008 had very toxic debt. So the way I see it is, if you can buy a home now, even if you're going to pay 10% over what you think it might be worth or 20% over what you might think it's worth, if you're holding it for the next 10, 15, 20 years and you have great debt and you can weather a storm no matter what happens, buy now and hold, because sales and real estate, it's all cyclical. We go up, we go down, we go through market cycles. And as long as you can buy, hold, and you're not going to end up giving the keys back to the bank, put your family first and don't think about the crash, because you're never going to time it right. And when it does crash, you're probably not going to want to buy then either, because then you're going to be trying to find the bottom of the market and it's just a bad cycle and you can't time anything perfectly.
I'd love to hear where you think things are heading, so people can kind of wrap their head around that.
So as long as you don't hold me to it. No. So I'm a very, very half full glass kind of guy. My glass is always half full. So I'm a realist, but I'm always very optimistic. So if I were to give you my 2 cents, I think we're going to see the rates rise 3 times between now and the end of the year. I reckon we see a 0.75 point raise between now and, again, the end of 2022. I think inventory will become a little more available as the year goes on. I think that if we see rates go up, we hope that we see prices come down a little so that it somewhat evens out. I don't want to see the market keep going up. I want to see the market level off. I think we're already starting to see that. And I just want, the market to continue to remain steady. By the end of this year, I think we're going to see, Again, rates up probably around a point, inventory more available, but I do believe the buyer demand will remain in place, and I do believe the market will remain strong.
Most people do think about the interest rate, but really they're thinking about how much can they afford.
Yeah, what's their monthly payment?
Right.
Yeah.
So is that must be going on right now, huh?
It is. It's going on quite a bit. So even for us, where we are, if we sold our house and let's call it for $1 million in our neighborhood, then at that point, if we want to laterally move to a similar home, or maybe want to upgrade a little bit to a better home, you can't find another one of my houses for the same price. To get a similar house, right? I'm either going to buy another $1 million to $1.4 million home. And I also have a higher interest rate. So if I'm at a 3% right now interest rate because I refinanced or something over the last couple of years, I'm going to sell my home. Sure, I'm going to scoop all that equity out that a lot of people have built up over the last 2 years. But I'm going to have to put it right back into the next house, but have a higher payment even just because my rates jumped another almost 2 points, depending on where you're at, including another couple $100,000 extra in purchase price. So my payment might go from $4,000 a month to $7,000 a month that quick to get not that much better of a house, depending on where you're at. And that's a big number just because some people might live in areas where homes are 200,000, 300,000, 400,000. But in the Seattle market, the median home price in King County is almost right around $1 million.
In a normal housing market where you can, upgrade over time, that's such a big difference in the payment. It's gonna reduce the number of listings, I would guess, and it's also it's gonna keep people in place. So it's gonna reduce the migration because they probably have to move out of the area, right?
Yeah.
Right, and find a cheaper area.
Yeah, and some of those cheaper areas aren't becoming cheaper. So maybe you're moving from a better location to a worser location just because of affordability purposes. Also, there's some people that are selling their homes, scooping that equity, and then maybe they're going to go rent and go see what the market does too, which I think that might also not be the best play depending on what your beliefs are, what's going to happen in the market.